You're listening to the Maven Approach podcast, the show where we interview passive real estate investors from every walk of life who share their experiences in passive real estate investing while still working their full-time job. If you're someone who's wanting to start or grow your own cash-flowing portfolio while continuing to do what you love, you're in the right place. Here's your host, Chad Fowers.
All right, Carson, thank you so much for coming on the show, the Maven Approach podcast. I just want to say thank you and welcome.
Yeah, no problem. Glad to be here.
Awesome. Well, hey, really just want to take some time and talk about some different strategies involving real estate that have to do with taxes and wealth planning, financial planning. So why don't you just give us a quick background of your profession, what you do, and we'll start from there.
Yeah, so I'm a financial planner. I work with a group called Onyx Bridge Wealth Group. And basically what we do, we have what we call a virtual family office. So for clients who, kind of are in our target demographic or that would benefit from what we do, we combine tax, law, wealth management, insurance, business advisory, all under one roof so that we can, give clients a more comprehensive plan and more comprehensive advice versus just having all their different professionals in silos, like their accountant or their financial planner, their insurance person, giving them, advice separately. We try to combine all that and really create a team approach. And so a lot of what we do centers around tax planning and those kinds of things, and just trying to help the client, put them in a better position than they otherwise would be. So
awesome.
I don't know if that makes sense.
No, that's great. Yeah, so you help kind of a holistic view of wealth planning for clients. Who's your typical client that you deal with?
Usually a lot of our clients are business owners, successful business owners, people that are in the higher, the highest tax brackets. So, and then people who have liquidity events. So a lot of clients that we work with, they're selling appreciated assets. A lot of times that's real estate or businesses, and they want to know what they can do to save on taxes and kind of how to plan for after the sale of, sometimes they'll have one asset. There's a client I'm working with right now. He has over half of his net worth is just in one commercial real estate building. It's worth about $15 million. And he's looking to potentially sell that. And there's a huge tax liability that comes with something like that. So those are kind of where our clients are. They, like I said, either selling appreciated assets or they have high incomes from their businesses, and they have more complicated situations and they need help with more advanced planning.
That's fascinating. I think that definitely is relevant to the audience that we're speaking to. So you had mentioned that a lot of the people that you work with have liquidity events. You gave the specific example of selling a real estate asset and kind of the implications there. Can you help me understand a little bit of what the implication of selling an asset of that value would look like as far from a tax perspective?
Yeah. Most of the time, like if they're selling land or rental real estate, commercial real estate, there's usually we oftentimes see a very low basis. Maybe the property's probably been in the family for a while, so they bought it at a low price or they've depreciated it over many years. And the example that I was given earlier, it basically had a zero basis. And, when you're selling something like that and it's comprised of a significant amount of your net worth, you could have, depending on which state you live in, like California, it's pretty bad because they just have a really high state income tax. So some of these people, they're looking at, between the federal income tax, state income tax, and then there's also on assets, capital gains over a certain amount, there's like another kind of like Medicare tax. That's another 2.3%. And all those combined sometimes could be anywhere between 25 and maybe even close to 40% under current tax law, and that's only looking to get worse. Kind of as they're considering new tax legislation, they're looking at raising those rates. So selling a $15 million asset, you're giving essentially a third away in taxes, which is a pretty big bite out of someone's what they're hoping to get out of it.
That's a $5 million haircut in that case.
Yeah, exactly.
Interesting. You mentioned the word basis. Just for the people that don't understand, can you just explain a little bit of what you mean by basis?
Yeah. So when you purchase any asset, whether that's stock or real estate, even a business, you have a basis, whatever your purchase price is. So in this case, obviously real estate, if you bought a property for say $1 million, that's your basis. So if you sell it for anything above that, if you buy it for $1 million and you sell it for 1.5, then you only owe taxes on the 500 gain that you had because you purchased the property with after-tax dollars. And then any improvements you add to the property. So if you buy the $1 million property and you spend $500,000 remodeling it, then 1.5 million, your purchase price plus your improvements, that's your new basis. So you only pay taxes on anything above that. And then obviously with real estate, you can depreciate it over a number of years, and that lowers your basis. So you kind of get a tax break with the depreciation up front, but then that's recaptured later whenever you sell the property, assuming you sell it for more than you bought it for. If you sell less than what you bought it for, then usually that's a capital loss. But in today's market, we don't see that a ton. Most people are doing quite well when they sell their properties, at least today.
Yeah, I'm sure that you see a lot of appreciation in these markets. So you had mentioned that in the case of the example that you gave, potentially looking at 25 to 40% tax liability on the sale of an asset. That's just as is. What does it look like working with you and your team and your company, and how does that help someone, and what would be an after tax liability after working with you guys?
Are you looking to grow your net worth through a cash-flowing real estate portfolio, but lack the time or know-how to get started? Maven Capital Group is your solution. We're partnering today with passive investors to grow their wealth through multifamily real estate. If you're interested in learning more about us and our process, head on over to mavencapitalgroup.co/free training. That's mavencapitalgroup.co/free training.
Yeah, it just depends. There's a number of different strategies out there that can potentially minimize or defer taxes. So really just depends. Number one, what are the client's goals? What are they trying to accomplish? What do they need the money for? Do they need it? Do they need the money for something else? Are they just going to live on it for like their retirement? So that's kind of where we first start is, what do we need this money to do? And then from there, we can come up with a plan to kind of help them lessen the tax burden, because what you don't want to have happen is you don't want the tax tail to wag the investment dog or whatever you want, however you want to say it.
Yeah.
Or if you're just planning for taxes and you're just trying to pay the minimum tax possible, sometimes that can lead you to do things that maybe will minimize your tax, but they're not necessarily the best in the long run. So just working with the client on what their goals are is obviously the most important thing. And then from there, we have a number of different potential strategies that can minimize that tax. So I don't know if you want me to kind of talk about what some of those are and how they work, or.
Yeah, if you don't mind, that would be super helpful.
Yeah. So some of the strategies we have, kind of go into kind of high level, because there's some nuances with many of these things with the tax code. Just over 70,000 pages in the tax code, just to give you an idea how
Wow.
complicated it truly is. So we work with different specialist tax attorneys and CPAs that actually execute and advise on the strategy. So myself, I don't do the technical work. I'm more educating the client and explaining how they work. So that's why I kind of go over high level, not too technical. But some of the strategies we use involve charity. One of our specialists likes to say, you can either choose to give money to your kids, the government, or charity. You get to pick two of those. And, most people, if they had a choice between giving money to charity and giving money to the government, they would pick charity. So typically speaking, if we're dealing with clients selling properties, we're better off planning before the sale. We can still help people after they've sold, but it's much better to pre-plan. Clients, if they call and they say, hey, I just sold my business or my real estate for $10 million, what do I do about taxes? Like, if they call me before that, there's a lot more that I can do to help them. So that's just kind of a caveat. But if we're pre-planning, for instance, like I said, in the charitable realm, there's lots of iterations of this, but just kind of on a high level, there's different types of charitable trusts that you can place the property into prior to the sale. And what that does is, technically, there's, like I said, there's some nuances here, but technically what happens is the charity owns the property, or the charitable trust owns the property, and 501c3 charities, they don't pay taxes. So when that building is subsequently sold, no taxes are paid in a lot of cases with the way we structure it. But then obviously, the client, they want, if they need access to the money, then, what do you do there? They don't want to just give everything away. So a lot of these different charitable trusts allow different types of things where you can still take an income from it. And then at the end of your life, that's when it actually transfers officially to charity. So you get the tax break up front. So you actually get two tax breaks. The first tax break being when you sell the asset, there's no capital gains reported. And then secondly, because you've donated that asset to an actual charity, you get a deduction on the value. Now it's a discounted value because the charity doesn't get the asset right away. They get it maybe 30 years down the road, but you get a deduction. So depending on how old the client is, that deduction can vary, but, it could be, like I said, it's going to vary, but, it might even be up to 50% or more. So if you donated a $10 million asset that, let's say, you had a $1 million basis, you sold it, you eliminate $9 million of capital, what you would have paid capital gains on that $9 million. And then you might get another $5 million deduction that you can use against your ordinary income. So if clients have IRAs or things like that, they don't have $5 million in income, we'll convert those to Roth. We'll use up the tax deduction to help, get the most benefit out of it. And it does carry forward for about 5 years. And then, like I said, those charitable trusts, depending on how you structure it, usually you can claim like an income stream for the rest of your life. In some cases, some tax attorneys can structure it to where you can kind of borrow from it tax-free. And then usually using some of that tax deduction, if clients want some of they intended that money to go to their children, say, a lot of times there's enough tax savings there on these assets. If it's big enough, we can just purchase an after-tax life insurance to kind of replenish that asset, if that makes sense. So they have a $10 million asset going to charity. They're still getting the income stream while they're alive. But then that $10 million asset goes to charity when they pass away. Usually husband and wife pass away. A lot of times we can use, because the tax savings are so large, we can have the government essentially pay for what ends up being an insurance policy to replenish those assets. So that when they die, even though that $10 million asset's going to charity, they have a life insurance that then goes to their kids that replaces that asset. And they're able to do that because of the tax savings. So that's just kind of kind of an example, high level of how charitable planning can benefit you now. So a lot of people, if they leave money to charity when they die, that's actually not very good. They can actually set up these charitable trusts today where they can get the tax deduction today, and then that money doesn't go to the charity until later on, usually when they pass away. So it's just a better way of planning.
Wow.
Than kind of the traditional way.
So that's something that they want to do before they actually have that liquidity event, set that all up. How long before the liquidity event would you say someone needs to start considering that?
It just depends, but typically, the sooner we can get to them, the better. Usually, we want to do it before it's under contract. So if they're going to sell it and, maybe they've got a letter of intent, we want to try to get it before that. So if they know they're going to sell it and they don't have an offer yet, but they know it's going to happen, that's when we want to start having these conversations. And usually that's a few months before the sale.
That makes sense. With the charity, do you get to select the charity that goes to? Or is that just a specific charity to select from?
Yeah, so the clients get to choose the charity. It's whatever they want, as long as it can't be, in most cases, it cannot be like a private foundation. So some clients you can actually set up your own charity, which is called a private foundation. And there's some tax benefits to that too. But for a lot of these strategies, it's got to be what they call a 501c3 public charity, which there's quite a bit of those out there. And then they can also do something called a donor advised fund, where that's actually a charity itself, but it's managed through the fund, and they kind of get to choose. They can dole out the money kind of as they see fit. Like I said, either when they pass away, or in certain instances, like if they want to give money to charity while they're alive, they can do that as well.
How much of the liquidity amount that they actually receive can they distribute to themselves as income from the charity account? And is it amortized over a certain amount of years, or how does that calculate?
Yeah, so like I said, there's some different iterations of it. So just speaking generally, you can typically set that up, kind of customize it, so they could say, so like on some of these, usually like kind of the bigger percentage they take, usually the lower the deduction. Like, so they're still eliminating the capital gains, or at least deferring it. But so like say they take a 10% income from it every year, like they're going to get 10%. That's going to lower what the deduction amount is on their tax return.
Gotcha.
Versus if they take a 5%, but it all depends on what they, how much they need from it. So that's where we customize it. And then there's other types of structures where it's invested kind of in a pool, but the money splits, like half of the income goes to the charity, half the income comes back to the person who put the money in the trust. But when we calculate all the numbers,
Okay.
we want to make sure it works out that, yes, there's these set of funds that are going to charity, and obviously that's good. But we also want to make sure that when it pencils out, that they're actually getting more back than they would have if they had just paid, if they just paid a check to the government.
Right.
So that's kind of what we, for these structures, it does work better if clients are more charitable in nature. But again, usually when you present them the option of, hey, pick two of the three, government, children, charity, most people are they're gonna be charitable versus the government, the government. So
yeah,
at least that's kind of been our experience.
Yeah, that makes sense. Is there any other structures or strategies besides the charitable account that they can use pre-liquidity event that would help them reduce their tax liability?
Yeah. So there's another one we've used. It's kind of like you could call it a debt restructure. But essentially what happens is there's a dealer that kind of sets these up. They're a dealer of assets. They buy and sell assets. They'll actually come in and buy the asset from the owner, and then they actually sell it on to the end buyer. So this can actually, you can do this even if you have it under contract. It's kind of an alternative to a 1031 exchange. But
Yeah.
it utilizes part of the tax code 453, which is installment sales. And it sounds a little complicated when you first hear it, but once you understand it, it's actually not terribly complicated. But essentially, the dealer comes in and they buy the asset from the person selling it. They sell it on to the end buyer, and they buy the asset on a 30-year interest-only note. So what that means is, like with an installment sale, which like is your audience, are they kind of familiar with like seller financing type of arrangement? So just similar to that, it's not a seller finance, but it's similar to that. Like if you were to sell a building, say for $1 million, and you did that over 10 years, you're getting $100,000 plus whatever the interest rate is. You're only paying taxes on the amount of money that you receive when you receive it, right? So if you sold a building for $1 million and on a 10-year installment note, you're getting $100,000 a year plus interest, and you're only paying taxes on the $100,000 that you get as you receive it. Now, this installment sale is a 30-year interest-only installment, so you're not getting any cash up front from the person that you sold it to. But then, obviously, how does that benefit you? The dealer, they have lenders that will actually loan up to 95% of the proceeds to the seller. So they take that also on a 30-year installment note, and the interest rates essentially cancel each other out. So you have an interest-only installment note that you sold, that you're getting from the person who bought it from you, and at the end of that 30 years, that's when they pay you the full balloon payment. And then on the lender side, you're getting 95% of the proceeds, again, interest only, that you're paying to them, and you pay the balloon payment at the end of the 30 years. So what that essentially does is you're getting 95, what ends up being at the end about 93.5% of the proceeds up front, tax-free, because you're getting it via a loan. Loans are not taxable. And then at the end of 30 years, that's when the actual tax liability is due, because that's when you receive the final payment, the balloon payment. Well, what that essentially does is it gives you the time value of money. So if you're investing those funds over 30 years, just the tax savings alone, at an even, kind of a hypothetical conservative rate of say 6 or 7%, you're more than recapturing everything that you would have paid in taxes, plus much more. So for instance, if your tax liability, say it was a $10 million asset, your tax liability was just say $2.5 million, and you took that $2.5 million and you reinvested it, because you would have paid that in taxes anyway. You reinvested that over 30 years. That ends up being more than the $10 million that you started with. If you had, say, a 7 or, I think like a 7% rate of return, you have more than $10 million at the end, just on the money that you invested that you would have otherwise paid to tax. So even if in 30 years, because you pay the taxes at whatever the rate is in 30 years, so even if the taxes are 100%, which seems kind of unlikely, but even if it was, you're better off because you've made more money than that, assuming you invested prudently.
Right.
So that's kind of how that works. There's no charities involved or anything. It's just kind of a debt restructure where you're taking that money on an installment note versus getting the proceeds up front. So I know it's a little complicated, but that's another strategy.
No, that makes sense. Yeah, and I think the big key takeaway to that is that really you want to sit down with a wealth advisor, a financial advisor, to set that up. And I'm sure you guys have charts and graphs and everything that can easily explain it to someone that's experiencing a liquidity event in their lives, right? Like
Yeah.
it's one thing
Yeah.
to understand all the ins and outs, but at the same time, that's your job, and that's why you can help people do these different strategies to benefit themselves from taxes.
Yep. Yeah. And usually, yeah, that's one of those things where sometimes you have to explain it 2 or 3 times before someone gets it, but once you kind of get it, it makes sense. So there's that. Another strategy we have, that's a non-charitable strategy. I'm guessing your audience might be familiar with it, is the qualified opportunity zones. Have you guys talked much about that on the podcast?
If you could fill us in, yeah, we haven't talked a lot about
Okay.
that, but if you want to fill us in on what that is and the implications, that would be great.
Yeah, and interestingly enough, a lot of people don't even know what it is. A lot of clients I talk to, they've maybe heard of it, but they don't know much. So it's one of those things that's probably underutilized. But one of the things that changed in the recent tax codes, the 2017 Tax Cuts and Jobs Act, was they instituted these qualified opportunity zones, which is essentially kind of an incentive for reinvestment into what they consider distressed areas of the country. And what was I going to say? Essentially, it provides a tax incentive, and it doesn't matter if it's real estate or it can be any capital gain. It could be a capital gain from a stock, but a lot of times it's real estate.
Yeah.
And what it allows you to do is there's these different opportunity zones that are set up for reinvestment. And even though it's like supposed to be distressed areas, the tax law allowed the governors to pick those different areas. And some of them are actually pretty nice. Like some of them have like Hilton hotels, things like that. But it's essentially kind of like, you can kind of think of it like a REIT, a real estate investment trust, similar to that, where it's a pooled investment. It goes in, and part of the investment has to be on improvements. But when you put the money into the qualified opportunity zone, similar to a 1031, you defer the taxes. The nice thing is it's a lot simpler. You don't have to have like a qualified intermediary. So, if you sold your property this year, you didn't do a 1031, and maybe you're like, oh, maybe I should have. You can still do the opportunity zone fund. And so when you put your money into it, the nice thing about it, actually, that's kind of more beneficial than a 1031, is you don't have to roll your whole proceeds over. With a 1031, in order to get the full tax benefits, you're rolling over your basis plus your gain. With this, you can actually just roll over your basis, or sorry, your gain. So like we had a client that they sold some property for a couple $1 million, and about I want to say a third to a half was their basis. 1031 didn't really make a lot of sense for them because they wanted some liquidity. They needed some of those funds for things. But there was obviously a fairly decent tax liability there. And we haven't done this yet, but we've been talking to them about it. They can roll over. They had, say, a $2 million sale. About $750,000 was their basis that we talked about. So they have this 1.25 million. They can roll that over into the qualified opportunity zone and defer all the taxes on that, and they can keep their basis tax free. So that $750,000, they can just keep that free and clear, tax free, and they don't have to roll over all their gain. They could roll over half of it or any amount that they want, really, and it defers the taxes for 5 years. In the 5th year, they do pay the taxes, but per the law, they get a 10% step up in basis. So just as an example, if someone rolled over, they put $1 million of gain into the opportunity zone fund. And these are funds that are set up. They'll get a 10% step up in basis. So they only pay taxes on $900,000. So the first is the deferral. Second is they get that 10% essentially discount. The real benefit of these funds, though, is if you keep it another 5 years, so you had the first 5 years, you paid your tax on 90% of it, and then you keep it another 5 years, any of the growth on that fund is actually tax-free. So even though it's being depreciated, if you're pulling income from it, whatever the case is, any of the appreciation from then on out is tax free. So just to follow that example, they rolled $1 million over, they deferred that $1 million tax for 5 years, then they only pay taxes on 900,000. Now, at the end of the 10 years, after they've held it for 10 years, if say the investment, if it performed well, say it went from $1 million to $2 million or more, that extra $1 million that they gained, they normally would pay taxes on that in a typical investment when they sell it. With the qualified opportunity zone, there's zero taxes owed at the end of that 10 years. So if the investment does really well, say it triples, then that's a $2 million tax-free gain that they got in that example. So that's the real benefit, is not just the deferral, but the tax-free growth. You can almost think of it like a Roth IRA in that sense, where you did pay taxes on part of the basis, but then you got that growth that you could pull out, and you don't have to wait till 59 and a half like a Roth. But that's a qualified opportunity zone, and it can be really good. Obviously, the downside being that it's not liquid. It's not something you can just pull your money out. In most real estate isn't liquid. So, if people are familiar with real estate, they're obviously okay with some of those things. But yeah, that's another one. Like I said, it's pretty underutilized, and there's not a ton of time left on the clock for that, because it's kind of a temporary.
Right.
But yeah, I think it can be really great.
And then on the backside, sorry, didn't mean to interrupt you, but on the backside of the opportunity zone fund, can't you tap into those as real estate investors to go purchase multifamily property or any type of real estate in that zone? And that's where that return to the investor that's holding their money comes from?
Yeah, so within the qualified opportunity zone, these are set up usually by professional real estate management companies. And there's different ones, they could invest in, and this is where, like I was saying before, where the tax, you want to make sure you're not just doing it for the taxes, because there is some nice tax benefits. But if you get into one and say it's a kind of a crappy investment, if you lose money in it, you put $1 million and then 10 years later it's only worth half, then your tax benefit didn't do you any good because you lost money. So obviously the investment has to be sound for it to make sense. But typically they're invested in all kinds of things. It can be multifamily residential storage units. I'm aware of one fund that does that. Hotels. I mean, it really could be any type of real estate investment. There are certain rules that they have to follow in order to get the tax benefits, and a lot of that has to do with half of the funds, I believe. Don't quote me on that, but somewhere in that range has to be in improvements. So they go buy property and then they have to put X amount of dollars or X percent as an improvement to the property. And it's supposed to help revitalize some of those downtown areas and things like that.
Interesting. So with the 1031 exchange,
when you sell an asset and then you transfer those gains into another similar or like kind asset, then you can defer those taxes down the road. Is that correct?
That's correct. And actually I was going to mention that too. We do help investors a lot with 1031 exchanges as well. So that's just your traditional, if you sell a property for whatever amount, if you 1031 into a new property, they call like kind exchange, then you defer, defer if you put all the money into it, your basis and everything, you defer 100% of the tax. And that's been, a great strategy for a lot of people. If clients, they don't want to manage their own real estate, we have something called a DST, 1031 exchange, Delaware Statutory Trust. But essentially, again, it's like a REIT or a mutual fund where you can buy into these larger properties that are professionally managed. And you don't have to do anything as far as other than just picking, which investments you want. You don't have to manage it. It's part of a pooled investment. It's professionally managed. And You just collect the rent payments or the interest per whatever your share is, and you can still defer all the taxes. And so a lot of people do that. They call it, there's a strategy they call swap till you drop, which essentially is, you have these highly appreciated real estate assets. You continue to 1031 them until you just essentially die. And then under current law, all those assets, they get a step up in basis. So say someone bought a $500,000 apartment complex, 30 years ago, and they've sold it, they 1031'd it, they did that over 30 years, 40, 50 years. And say now it's worth $5 million. If they were to sell it today, they'd owe $5 million in tax. But if they keep 1031ing it into new properties and, they pass away, whatever that's worth there at that time, say, like I said, it's worth $5 million, that gets the step up in basis. So their kids inherit it, whoever they want, kids or grandkids. And now they sell that property, they pay zero taxes.
Zero, yeah.
So the obviously the unfortunate thing is you have to do that until you have to die in order to get the tax benefit. The actual, you're really only deferring the taxes with the 1031, but
right.
Under the current law, when you pass away, that's when those assets, they call it the step up in basis, and whatever the fair market value is, whoever inherits that property, they can sell that for zero tax. They are talking about changing that law. But currently it can be a good, if you just want to own real estate and never pay taxes, that's a really good, a pretty good strategy, I would say.
So you had mentioned that's on the chopping block for future legislations. Do you have any idea when that is expected or what that looks like?
No, it's not my area of expertise, but I know, we've talked with, we have a lot of tax attorneys and other folks in our group that follow that closely, but it's something that the Biden administration has said that they were going to look at changing. So actually they were talking about two different things, eliminating the step up in basis, which would be any assets that you have, whoever inherits those, they're going to have to pay the taxes on them. Whereas right now that's not the case. And then the other one is actually eliminating or minimizing the 1031 exchange. And I think they were talking about limiting it to $500,000 a year, something like that. But I know this is all things they're talking about. So right. It's possible they could pass this legislation by the end of the year, next year. There's no telling when. There's probably going to be changes to it. And usually it's going to be more complicated than they let on. As far as some of it'll be allowed, but there'll be exceptions, or there'll be minimums where, if it's under $1 million, they get the step up. Those are different things they've talked about. So certainly that's part of the reason why we have such a complicated tax code, because every time they add to it, it just gets more complex.
Yeah, your job is a lot funner when they add to it.
Yep.
Cool. One question. So with the 1031 exchange, obviously they're getting that tax deferral on the step up when they sell the asset and purchase another asset. How does it work with cash flow? So obviously we focus on multifamily real estate in this podcast. So obviously we know that the gains are deferred. What happens with the cash flow? Is that at all included or involved with the 1031, or is that just taxed normally?
So yeah, I mean, any cash flow, like from the property, like you're collecting rent, that's going to be taxable as ordinary income, minus whatever depreciation you have on the building. And actually that's another strategy we can go into, depreciation, but typically on a residential property, it's, I want to say 28 and a half years or 29 and a half years. I can't remember exactly. You depreciate a property, excuse me, over that period of time. So, say it's $1 million property that you bought it for, divide that by 28. That's that's how much you can depreciate every year. So that counts against your income. So that ends up being like on $1 million property, say $25,000
Yeah.
a year. So if you had 30,000 of income from the property, only 5,000 is taxable because you depreciated that 25,000 or whatever. And
that's
so the
available.
1031 doesn't necessarily affect the cash flow. So whenever you 1031, it's just the capital gains.
Capital gains.
So I don't know, maybe that was a long way of answering your question, but you're just deferring the capital gains, and then any of the income from the property, that's still taxable at
Right.
Ordinary rates minus what, like I said, whatever depreciation you have.
Is that the best tax sheltering strategy? Do you feel like for cash flow is using it using the depreciation to offset the cash flow income? Or is there any other strategy that you can use to do that?
Yeah, that's a good question. So like you said, under normal situations for residential, it's like about 28 years. You depreciate over the property over that period. On commercial real estate, it's 39 and a half. So it's even longer. So you're getting less depreciation on a year by year basis. We do have a strategy we do a lot with clients. It's called cost segregation. Not sure if your audience will be familiar with that, but it's a way of accelerating the depreciation on a property. So essentially what the tax code allows you to do is you can segment different parts of your property. Like for instance, like carpeting, fixtures, they all have their own depreciation schedule. And you really have to have a specialist do this. It's not something you can do on your own, or even most CPAs are not equipped to do this. Some of them are, but very few. So we actually have a specialist on our team. All they do is cost segregation studies, because they got to come in, they got to look at the blueprints, they got to have an engineer, look at all the different components of the building. But what ends up happening is they can accelerate that depreciation. So the client or the real estate owner is getting more depreciation on the front end, right? So say and usually this only works for larger properties. So
Right.
700,000 or more of building. The land doesn't count. You can't depreciate land. So it has to be the building. So we usually find if a property itself is worth 700,000 or more, usually the bigger, the better, the more benefit.
Yeah.
You can accelerate that depreciation. So if you have $1 million property, and instead of accelerating that over 28 years, you can get, say, $200,000 or $300,000 of depreciation in the first few years. That's more beneficial to you. And again, you're not getting more depreciation. You're just getting it in a compressed time. Like if I was to say to you, I can give you $100,000 now, or I can give you $100,000 30 years from now. What would you rather have? $100,000 now, right?
Right.
It's better to have money in my pocket now, because
Right.
then I can reinvest it and I can grow it. So that's the benefit of the accelerated depreciation is you can get more money up front. That money can be reinvested, versus waiting or versus doing that over like a 28 or a 39 year period, right? So that's another good strategy. That's more to do with just owning the real estate versus selling it.
Yeah, and I guess there's two different audience members that we're dealing with. Obviously, the person that finds a value add property that they can go in and fix up and then sell in 5 to 7 years for appreciation, while getting cash flow in between. And then there's also the person that plans on buying an A-class asset that is stable and already cash flowing, and they want to hold that over 30 years. So it sounds like the accelerated depreciation and cost segregation is probably more geared towards someone that's looking to probably sell in 5 to 7 years to be able to take advantage of that accelerated depreciation versus the person who wants to hold.
I would actually say it's probably more so the opposite, because the problem, and just kind of goes back to what I said earlier, like when you accelerate, or whether you accelerate the depreciation, however you depreciate it, if you just do a straight line depreciation, when you sell the asset, you have to recover that. So if you're holding the asset for a long time, it doesn't matter. You're getting that additional cash flow up front, which you can then, like I said, reinvest into other real estate or making improvements. if you accelerate the depreciation and then you sell it 3 years later, well, then you just recaptured all that depreciation. It can still be beneficial, like if you use some of the strategies we use, for either eliminating or deferring the capital gains, right? If you're just going to 1031 into a new property, or you're going to do like the qualified opportunity zones or whatever the case is, charitable strategies, then in that case, the person that's using the 5 to 7 year flip, it's still beneficial for them because they got the accelerated depreciation and then they deferred the taxes or, eliminated the taxes through some of these other strategies. So it can work for both, but the person holding it for a long time, it works really well too, because they're just getting more cash flow up front, which can then be reinvested.
Interesting. Okay, cool. Man, that's a lot. That's a lot today.
Yeah, I know.
I think that's really helpful to understand. Again, I think the key for real estate investors and the people listening is that you need to find a professional that knows how to do this stuff, right? It's not something that you necessarily need as information retention. To be successful at real estate investing, it means that you need to build your team around someone that understands all the caveats of taxation and wealth building, to be able to really take advantage of all of this.
Yeah, absolutely. It's more important, you don't have to know all the ins and outs of the tax code, or but just more important to know that it's out there, and get set up with someone who can actually implement these things. Because it's not, you're right, it's not something that you can just go do on your own. In most cases, you really need professionals to
Right.
be able to implement this stuff.
The last thing that I want to finish up on is there's the difference between being like an actual single owner and maybe being a passive investor in a larger syndication for an apartment building. Are there tax differences in those two? Or if I was a passive investor that just brought cash to the deal and there was a separate operator, property manager, everything like that, what does that look like as far as taxation?
There are some differences, and this is where, like I said, I'll qualify this by saying I'm not a CPA, but
Yeah.
just from what I understand about it, there's a difference, at least under taxation, for someone who's what they consider, like you said, a passive real estate investor, and someone who's active. And there's a certain amount, there's a qualification there that the IRS determines, like whether you're active or you're passive, and it's a certain amount of hours. And I honestly can't remember on the top of my head what that is, but it's almost like a full-time job. Like if you're doing it as your full-time job, you're considered an active real estate investor.
Mm-hmm.
And so you do get actually some additional tax benefits from being an active versus a passive. So for instance, with that depreciation example, say you accelerated the depreciation on an asset, and the depreciation was more than your income. So you offset all of your income. If you're an active investor, you can take those losses, those real estate losses, and you can apply them to other income. So say you had real estate losses from depreciation, plus you had you had a business, maybe it's real estate and real estate related, maybe it's not, that had income. You can deduct those losses against your other income. Whereas if you're considered what's a passive investor, you can only deduct those losses against other passive losses, if that makes sense. So by being an active real estate investor, you get some additional benefits where you don't if you're just a passive. And it mostly has to do with capital losses or depreciation losses, whatever the case is, being able to offset other income.
Gotcha. Okay.
So that's kind of the main difference.
Gotcha. So if I'm a passive investor that just brings cash to the deal, and then I get a rate of return in the deal, is that taxed as a dividend, or how does that work?
It would be like, if it's depending on what your return is, if let's say you put money into an asset and then you sold it for a gain, if you sold the asset, as long as you held it for over a year, then that's taxed as a long-term capital gain, which is right now is lower. As of today, it's a lower tax rate than ordinary income. If you sold an asset that you owned for less than a year, then that's taxed at what they call short-term capital gains, which is essentially the same as ordinary income rates. So it's a higher tax rate if you held it for less than that year. And then if it's income from the asset, say, a rental property, then you're paying ordinary income on that. So I don't know if that, and that's the same pretty much if you're active or passive.
Okay.
You're getting taxed the same way. It's just, how do you apply those losses? Can you apply them towards, is it just you either apply them towards other passive investments, or you can apply them towards other income, and that's only if you're an active investor.
Gotcha. Well, good. I think that pretty much gives us a good idea of the world of wealth planning, financial planning, and real estate. Really appreciate you providing that information. I think it's very valuable. If you ever listen to Robert Kiyosaki or any real estate guy, you understand that taxes can be one of your largest expenses, and usually are one of your largest expenses, especially if you're in the real estate game and want to do well at it, right? If you don't plan it right, you could end up losing a lot more than you need to, if you don't have a good plan in place. So really appreciate kind of that insight, Carson, and want to just give you a second to let people know how they can get a hold of you for any of their questions or tax planning needs or financial planning needs that they have.
Yeah, and thank you for that. And hopefully it was helpful for your audience. I know it's a little technical, but at least hopefully it was informative. But if people want to reach out to me, they can email me. My email is cgrover@onyxbridge.com. I guess I could give my phone number out if that's helpful. 435-554-1851. If clients have questions about some of these, if like I said, if you're a real estate investor, you're selling a property and you want to know, how can I help, minimize taxes, or, if you have investments and you're in those higher income brackets, what can we do to lower that? Those are the kind of situations where we can provide the most value, I would say.
Awesome. Can you give that number one more time?
Yeah. So my phone number, 435-554-1851. So like I said, people can call me or text me, or email me at cgrover@onyxbridge.com. And that's ONYXBRIDGE.com.
Awesome. Carson, thank you so much for being on the show. Really appreciate it. Thank you for your time. And we'll talk to you next time.
Okay. Thanks a lot, Chad.
Well, there you have it. Thanks for joining me on another episode of the Maven Approach podcast. If you've benefited from something you've heard on this episode or any of our other episodes, please head on over to iTunes to leave a rating and review for the show. This helps us reach more people like yourself to elevate everyone around us. To learn more about Maven Capital Group and how you can be a part of our online community, follow us over on Instagram to stay up to date on all of our latest opportunities.